Good morning, dear students. This is Vijay Lakshmi here, your business studies teacher. Today we will start doing chapter 9.2, that is capital structure, concept and determinants. Now, first of all, we must know कि company जो है, how does it arranges its financial requirement. There are various sources of financial requirement through which financial requirement can be fulfilled, like by issuing equity shares, by issuing preference shares, through debentures, through long-term loans, through retained profits and current liabilities. Now, then we must know the meaning of financial structure. Financial structure means composition of liability side of balance sheet, means long-term as well as short-term sources of capital. After that, the next question arises, what is meant by capitalization? Capitalization means long-term sources of capital, means financial structure minus current liabilities. And now next question arises, what is capital structure? Capital structure means relative proportion, percentage of different sources of long-term capital. So capitalization is quantitative aspect of long-term funds and capital structure is qualitative aspect of long-term funds. Now, what is financial leverage? It means inclusion of fixed cost capital. Fixed cost capital means debt capital and preference share capital. We call it fixed cost capital because we have to pay interest on this particular sources at fixed rate of interest or fixed rate of dividend. That's why it is called fixed cost capital. So inclusion of fixed cost capital along with equity share capital in capital structure is called financial leverage. And what is financial risk? Financial risk means in case of adverse situation, when fixed cost capital increases, the burden of interest and fixed dividend. In adverse condition, inability to pay, this is known as financial risk. Now next is, what is earning before interest and tax, EBIT. What is EBIT analysis? It is that part of profit from which payment of interest and dividend remains to be deducted. It is also known as operating profit. Next is, what is trading on equity? It means to raise fixed cost capital, preference share capital and borrowed capital on the basis of equity share capital so that income of the equity shareholders may increase. Now, what are borrowed capital and preference share capital? Why they are called fixed cost capital? Because their rate of return is fixed, interest or dividend, whereas rate of return of owned funds, that is equity share capital, is not fixed. What is earning per share? Available amount left after deduction of interest and tax from EBIT is known as EAT, means earning after tax. This amount is available for equity shareholders. Earning per share can be calculated by earning available for equity shareholders divided by number of equity shares, right? Now next main, very important, how income of equity shareholders can be increased by raising fixed cost capital by the company. Now with the help of EBIT, EPS analysis, it can be found out as what will be effect of various long-term sources of capital on earning per share. Here we take example of two companies, X Limited and Y Limited. Now we assume X Limited has borrowed capital as well as equity share capital, Y Limited, and X Limited runs his business only with the help of equity share capital. यहाँ पे इसने कोई भी borrowed funds नहीं लिए, only owned funds, equity share capital, and Y company ने अपने owned funds in the form of equity share capital as well as debentures are being issued, right? But total capital of both the companies is 10 lakh each, right? X की जो है equity share capital 10 lakh और Y की equity share capital 4 lakh. X ने कोई भी डिबेंचर्स नहीं इशू किए, बट Y ने 6 लाख के डिबेंचर्स इशू किए. सो Y के ओन फंड्स एंड डेट फंड्स दोनों हो गए बोरोड फंड्स, बट टोटल कैपिटल दोनों की 10 लाख. यहाँ पे बेटा 10% डिबेंचर्स का मीन्स rate of interest on to be paid on debentures is at the rate of 10%. Now we assume the face value of per equity share is rupees 10. So number of shares in X Limited will be 1 lakh and number of shares in X Limited will be 1 lakh and in Y Limited will be 40,000. and it is assumed at the end of the year both the companies earn rupees 2 lakh each and tax rate is 30%. Now for calculating EPS, we need to analyze, we have to make a table, EBIT and EPS analysis. First of all, earning before interest and tax for both the companies is rupees 2 lakh. Now first of all, interest is to be paid on debentures, outside liability, right? Interest at the rate of 10% on debentures. X के कोई भी debentures नहीं है, Y के हैं 6 lakh के, interest will be 60,000. So earning before tax will be 2 lakh and 1 lakh 40,000. Now tax is paid at the rate of 30%. So tax will be 30% of 2 lakh 60,000 for X Limited and 30% of 1 lakh 40,000 42,000 for Y Limited. After that there is earning after tax that for X company is 1 lakh 40,000 and for Y company 98,000. Now earning per share can be calculated by dividing earning after tax divided by number of equity shareholders. X Limited के shares हैं 1 lakh, so EPS will be 1.40 and for Y Limited EPS will be 2.45. Now from here we can come to the conclusion that earning per share in case of debt capital is more than in case of the company which runs only on equity share capital. और ये कहाँ फेवरेबल होता है? जहाँ फिक्स्ड कॉस्ट कैपिटल आपकी कम है. अगर फिक्स्ड कॉस्ट रेट ऑफ रिटर्न जो है that is more than the fixed cost expenses, right? So with the help of this we come to know that the inclusion of debt capital is beneficial for the company if fixed cost is less than its rate of return, right bache? That's all for today. Thank you very much. I hope this topic is clear to you. Thank you very much.